We are looking live at Nuburu Inc., ticker symbol BURU on the NYSE American. As of 11:30 a.m. Eastern Time on this November 10th, 2025, the stock is trading at $0.2821 per share. That is a fractional gain of just over 0.5%, up about 0.0017 cents from the previous close. But this is a stock where the daily percentage move tells you absolutely nothing about the real story. The real story is the volume. We are only a couple of hours into the trading session and over 21 million shares have already changed hands. This is for a stock with a market cap that hovers around $38 million. To see volume that is more than half the company's entire supposed value trade in a morning, yet the price needle barely flinches, tells you this is not a normal investment. It is a battlefield. The immediate assumption is that this is just another volatile penny stock, a former SPAC that went public, collapsed, and is now just the territory of high-frequency traders and day traders flipping it for fractions of a cent. And if you looked at Nuburu 6 months ago, you would have been right. But what the market is struggling to price in today is whether BURU is a ghost or if it is a completely new company being built inside the carcass of an old one. The expectation for Nuburu, the one that most of the market still holds, is based on its original identity. This was the Blue Laser Company. It was founded in 2015, went public via a SPAC, and was supposed to be a leader in high-power blue laser technology for welding, 3D printing, and other industrial applications, particularly in the electric vehicle battery space. This was the narrative sold to investors. The reality, however, has been a financial catastrophe. If you look at their financials from 2023, for instance, the numbers are not just bad, they are baffling. In the third quarter of 2023, the company reported total revenue of just $0.2 million. That was a 78% collapse from the $0.9 million they did the year prior. Worse, their total gross margin was negative 497%. That is not a typo. It means that for every dollar of product they sold, they spent nearly $5 just to produce it, before even factoring in research, marketing, or executive salaries. The company posted a net loss of $5.1 million in that quarter alone, and finished that period with a terrifyingly low $1.6 million in cash. This is the expectation, a company that is fundamentally broken, burning cash at an unsustainable rate, with a business model that simply does not work. This is why the stock cratered from its highs and trades for pocket change, and it is why the 52-week range is a painful 0.12 cents to just under $1. Now, here's the reality that is colliding with that expectation, and it is the source of this 21 million shares of volume. This is not the old Nuburu. In the past few weeks, the company has announced a transformation plan. This is not a tweak. It is a wholesale pivot. Under a new executive chairman, Alessandro Zamboni, Nuburu is attempting to completely change its identity. They are transitioning from a struggling laser maker into, and this is their new framing, a defense and security hub. This plan is being executed through rapid-fire acquisitions. Just a few days ago, on November 6th, the company provided an update. They are acquiring an Italian software-as-a-service company called Orbit SRL, which specializes in operational resilience and crisis management. They have also announced a strategic alliance and joint venture with Maddox Defense for drone technologies. They are also, somewhat confusingly, acquiring another blue laser business, this time one that supposedly has an existing operational entity with engineers, R&D facilities, and a customer base in civil and military sectors. The company is, in effect, trying to become a defense tech roll-up, bolting on a software business, a drone business, and a functioning laser business to its existing public shell. This is where the story gets incredibly complicated, and it is a fascinating case study in market dynamics. The bull case is that this new management is using the BURU public listing as a vehicle to acquire and consolidate a new, high-growth defense company. They have even guided for initial billings from this new defense hub to be around $500,000 in this current fourth quarter of 2025. It's a small number, but it's a start. And it is a signal that the pivot is real. The bear case, however, is deeply skeptical. The acquisition of the Italian SaaS company Orbit is a major related party transaction. Public filings reveal that Orbit is wholly owned by none other than Alessandro Zamboni, the executive chairman and co-CEO of Nuburu itself. The company had to get an external financial advisor and its independent non-executive directors to review and approve a deal where the company's new chairman is essentially using the public company's and its shareholders' resources to acquire his own private company. This is a massive red flag for corporate governance, and it creates a huge amount of suspicion. What do you think of the executive chairman acquiring his own company, Orbit, using Nuburu's funds? Is this a strategic masterstroke or a massive conflict of interest? Comment below. This central conflict brings us to the most important metric for this stock, and it is the one driving that 21 million shares of volume. This is not a stock trading on fundamentals. It is trading on market mechanics. According to the most recent data from Fintel, the short interest as a percentage of the free float is 26.84%. Let's be perfectly clear about what that means. It means that for every 4 shares available to trade on the public market, one of them is a bet that the stock price will go down. Over 20 million shares are held short. This is an extremely high number and places BURU in the upper echelon of heavily shorted stocks. The shorts are not betting against the old blue laser company. They are betting that this new transformation plan is a shell game. Their thesis is that a company with negative 497% gross margins and dwindling cash cannot suddenly become a defense tech powerhouse, especially when its first major acquisition is a related party deal. They are betting that it will have to keep diluting shareholders to fund these acquisitions and to simply keep the lights on. And they are right about the dilution. The company's own press release from November 6th states it is strengthening its balance sheet through selective drawdowns under its standby equity purchase agreement. That is a polite way of saying they are selling new shares into the market at these depressed prices to raise cash. This makes BURU a powder keg. On one side, you have the shorts who see a fundamentally broken company trying a desperate high-risk pivot with questionable governance. On the other hand, you have a retail community, which you can see in forums across Reddit and X, who look at that 26.84% short float and see the potential for a massive short squeeze. The retail logic is that if this new defense pivot shows even a glimmer of success, like that $500,000 in Q4 billings, it could force a re-rating of the stock. A small bit of good news could cause the price to jump, forcing some of those 20 million short shares to cover, which pushes the price higher, forcing more shorts to cover, and so on. This is the battle we are seeing today. The 21 million shares of volume is not just buyers and sellers, it's shorts initiating new positions, existing shorts covering, and squeeze chasers trying to ignite a rally. So how can you, as an investor, responsibly navigate this? First, you have to understand the data. The 26.84% short float is public. You can find this data on platforms like Fintel or S3 Partners. This is your primary indicator. Second, you must look at the cost to borrow. This is the interest rate shorts must pay to borrow the shares. Right now, the borrow fee for BURU has been hovering between 7 and 9%. This is elevated, but it is not astronomical. It is not the 50, 100, or 200% borrow rate we have seen in legendary squeeze situations. This tells us that for now, it is still relatively easy and affordable for shorts to maintain their positions. Third, you must look at the days to cover. For BURU, this metric is only 0.46. This is very low. It means that given the stock's massive average volume, all 20 million short shares could theoretically be bought back or covered in less than half a trading day. This liquidity actually works against a sustained squeeze, as shorts are not trapped. They can get in and out with relative ease. Another metric that the retail investors are correctly pointing to is the off-exchange or dark pool volume. On many recent days, the off-exchange short volume ratio for BURU has been over 50 or 60%. This means a significant portion of the trading is happening away from the public lit exchange. This is often used by institutions and market makers to execute large trades without causing price spikes, but it can also be used to route short sale orders in a way that minimizes upward price pressure. For retail investors, this high dark pool activity is often seen as a sign of manipulation, where bearish bets are being placed in the shadows to suppress the price. Whether it's manipulation or just efficient market mechanics, the effect is the same. It frustrates bulls and complicates the price discovery. With a 26.84% short float, do you see BURU as a high-risk squeeze play, or are the shorts going to be proven right about the fundamentals? Let me know your stance. Looking forward, the entire thesis for this stock rests on one thing: Execution of the pivot. The old financials are irrelevant. The company's survival depends on its ability to close these acquisitions, integrate them, and, most importantly, generate revenue and positive cash flow from them before the dilution-based financing runs out. We are also watching the company's listing compliance. It was only in October that Nuburu resolved a non-compliance warning from the NYSE American for failing to make timely disclosures. This is a company operating on the edge, in all respects. The bull catalyst is simple. Any earnings report that validates the $500,000 Q4 billing guidance and shows a path to real, profitable revenue from the new defense and software segments. If that happens, the 26.84% short float becomes jet fuel. The bear risk is equally simple. The cash runs out. The acquisitions fail to generate revenue, the related party deal sours, and the company is forced to dilute shareholders into oblivion, or worse, reverse split and delist. So, as we watch BURU churn through 21 million shares to stay flat at 28 cents,